Today we are going to discuss on global money rush, why private equity and sovereign funds are betting on India. Over the last few years, something very big has changed in the global capital markets. The world's largest private equity funds and the most powerful sovereign wealth funds from the Gulf, US, Singapore, Europe, are all quietly rewriting their playbook around one word: India. Friends, this India investment buzz is authored by Dr. V.V.L.N.Sastry, financial economist, jurist, and international arbitrator. My name is Miss Tuba, and I am narrating his content to you all. Yes, FDI inflows into India crossed around $81 billion in FY 2024 to 25, up about 14% over the previous year. Singapore alone accounts for 30% of FDI equity inflows, followed by Mauritius and the US. Today, let's break down where this money is coming from, why they are shifting so aggressively to India, and what the New Deal playbook looks like. Where is the money coming from? Let's start with the sources. United States and global private equity, big global PE, and buyout funds like Blackstone, KKR, Carlyle, General Atlantic, Advent, Bain, TPG, Warburg Pincus all have large India books. They are investing in financial services and NBFCs, IT and digital platforms, real estate and rights, consumer brands and healthcare. These funds usually come in as growth equity or control investors with 7 to 10-year horizons. Gulf sovereign funds. From the Middle East and Gulf, we see ADIA, Abu Dhabi Investment Authority, Mubadala, PIF, the Public Investment Fund of Saudi Arabia, QIA, Qatar Investment Authority, ADQ, ICD, Dubai. A recent global study of sovereign wealth funds shows that funds like Temasek, GIC, Mubadala, QIA, and ADIA remain among the most active deal makers worldwide, with PIF emerging as a major new challenger. These Gulf funds are heavily backing infrastructure, renewables, digital infra, logistics, and platforms in India. Singapore, Temasek and GIC. From Singapore, the two big elephants in the room are Temasek and GIC. Temasek's total portfolio is about 484 billion Singapore dollars, and India now forms roughly 5% of its exposure. Recent coverage notes that Temasek's India portfolio is now around 40 to 50 billion US dollars, and it plans to invest up to 10 billion US dollar more over the next few years, focusing on consumer, healthcare, and green energy. GIC is similarly active across real estate, infrastructure, data centers, and platforms. Europe and others, Norway and pension giants, and then you have Norway's sovereign wealth fund, the world's largest, which has increased its India portfolio from about 17 billion US dollars to 24 billion US dollars in just 1 year by end 2023. Plus large pension funds like CPP Investments, Canada, Ontario Teachers, Australian Super, etc., especially in infrastructure and renewables. So when we say global capital flowing into India, it's really USPE plus Gulf SWFs plus Singapore giants plus European and Canadian pensions, all converging on the India story. Then the question to be answered is, why are they shifting to India? Now, why is this happening? Growth plus stability combo. India is one of the fastest growing major economies, while many developed markets are struggling with low growth or recession fears. FDI has multiplied about 20x since 2000. For global capital, India offers growth without the same level of geopolitical risk as some other emerging markets. Market size and consumption story. India is now the world's most populous country with a rapidly growing middle class. For funds betting on 20 to 30-year horizons, this is the perfect consumption plus demographics play. Temasek's investment in Indian consumer brands like Haldiram's is a textbook example of this long-term consumption thesis. Policy reforms and tax incentives. India has opened many sectors to 100% FDI under the automatic route and built a strong infrastructure pipeline. A critical point for sovereign funds. Section 10(23) FE of the Income Tax Act gives tax exemptions to notified SWF and pension funds for investing into Indian infrastructure, which has dramatically boosted their interest in roads, ports, power transmission, and similar assets. Green and digital opportunity. Global investors have climate and tech mandates. India offers both. Over $62 billion in energy transition investments between 2017 and 2025 in renewables, EVs, storage, and green hydrogen. Sovereign funds globally are now prioritizing digital infrastructure, data centers, fiber, telecom towers, with around $9.4 billion in SWF money in 2024 alone, a large share of which is in Asia. India sits at the intersection of digital plus green, which is exactly what their investment committees want. China plus one and friendshoring. As geopolitical tensions rise, many funds are following a China plus one or even China plus N strategy. They are not abandoning China, but they want diversification, and India is the most credible alternative for manufacturing, supply chains, technology, services. So, India becomes the strategic hedge in their global portfolio. The New Deal playbook in India. So what does the new playbook look like on the ground? 1. Platform deals. Instead of small fragmented assets, funds prefer platforms, renewable energy platforms, road infra platforms, data center platforms, healthcare and hospital chains, financial services platforms. They write large checks into a scalable holding company and then add assets over time. 2. Club deals. PE plus SWF together. You now see private equity funds partnering with sovereign wealth funds. PE brings structuring, execution, and exits. SWF brings patient, lower-cost capital with longer horizons. This combination is ideal for large Indian infra and green deals. 3. Longer horizons, not just quick exits. Sovereign funds and pensions don't need to exit in 5 years. They are okay with 15 to 20-year horizons in infra, renewables, and core assets. India, with its long-term growth curve, fits that model. 4. Governance and compliance premium. Global capital is increasingly sensitive about corporate governance, ESG metrics, disclosure quality, regulatory risk. Indian companies that show clean accounts, strong boards, and compliance with SEBI norms will attract better partners on better terms. What Indian companies should do now? For Indian promoters, CFOs, and boards, the message is simple. 1. Think like a platform, not a one-off project. 2. Invest in governance and transparency. This is not a cost, it's your valuation premium. 3. Align your business model with global trends: green, digital, consumption, and formal finance. Global capital is already knocking. The question is not whether the money will come to India, it's which Indian companies will be prepared to receive it. Hope the information is useful to you. Thanks for your hearing. Jai Hind.